pero últimamente yo sé que no, las cosas agitan.
Ahora, pero California es diferente, el clima de California, la vegetación es diferente, es bien bueno, me encanta.
Okay, let's start. Today we are going to do leases. We are going to talk about accounting for leases for both the lessee and the lessor. So we'll start off with how to do accounting for lessees, and then we'll jump into accounting for lessors, and then we'll do some special accounting items as well. So lessee is the individual that leases the, let's just say, the equipment from the lessor.
Oh, nobody too.
From the lessor. So I have a piece of equipment and you lease it from me. You're the lessee, I'm the lessor. Okay? And basically, leasing provides financial, operating, and risk advantages over ownership. So instead of me buying a piece of equipment, it's more beneficial for me to lease it because it has more advantages versus owning it. One being the financial, operating, and risk. Okay? So let's begin. So these are the different sections we're going to discuss. We're going to start off with an introduction to leasing. Then, like I mentioned, we're going to do accounting by the leasing, accounting by the lessor, and then some special accounting problems. First learning objective, explain the nature and economic substance and advantages of lease and transactions. So we start off with the main definition of what a lease is. A lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property owned by the lessor for a specific period of time. The largest groups of leased equipment involves IT equipment, transportation, construction, and agricultural. So what are the advantages of leasing? These are the top 6 advantages. There's 100% financing at fixed rate, so you finance the equipment at a fixed rate. It could be 10%, could be 8%, could be 12%. Protection against obsolescence. So basically what that means is at the end that the equipment is worth nothing, you are protected from that because you don't own the equipment. So it has no value at the end of the lease, it becomes the lessor's problem. Flexibility, less costly financing, tax advantages, and off-balance sheet financing are a couple of the other ones. So, conceptual nature of a lease. Capitalize a lease that transfers substantially all the benefits and risks of property ownership, providing the lease is non-cancelable. Leases that do not transfer substantially all the benefits and risk of ownership are operating leases. So we're going to start learning about 2 types of leases. There's what we call a capital lease and an operating lease. The difference between the two is who is the ownership of risk. Who is technically owns the equipment. Operating lease means you have no sense of ownership. And let me further explain. So, if the lessee capitalizes the lease records an asset and a liability generally equal to the present value of the rental payment. So this illustration here is basically just giving you an introduction of what a regular journal entry looks for a lease, a capitalized lease. So what happens is the lessee is going to debit leased equipment. So think about this as a fixed asset, as if because your asset on the books is your equipment, and a lease liability. The lease liability is the amount you owe to the lessor. So you get a piece of equipment for $100,000 and you have a liability of $100,000 to the lessor. Again, this is on a capitalized lease. We'll discuss operating leases next. On the lessor side, so the person that actually owns the equipment is going to have a lease receivable for the same amount of the lease liability from the lessee, and the equipment comes off their balance sheet. Okay, so they're just comparing what the lessee and the lessor records for a capital lease. So, in order to be categorized as a capital lease, FASB has identified 4 criteria. So 1 or more must be met for a capital lease accounting. So it has to meet one of these four in order for it to be considered a capital lease. If not, it automatically becomes an operating lease. Okay? So when we start doing problems, the first thing you need to do is when it gives you all the information in the problem, you need to look to see if one of these four items occurs. If it does, automatically capital lease, and you're going to do accounting for capital leases. If it doesn't have any of these criteria, then it automatically becomes an operating lease, and you will do the accounting for operating leases. Does that make sense? So, the first one, lease transfers ownership of the property to the lessee. So in this case, when the lease is over, when it expires, the property transfers to the lessee. The lessor no longer owns the property. That's criteria one. The lease contains a bargain purchase option. So this basically means that there's an option at the end of the lease for the lessee to purchase the asset from the lessor at a reduced price.
What is it? Like I have the lease with a car. When I enter the lease, I have
You have the lease
to buy
option.
the car.
Correct. That's a bargain purchase option. Number three, lease term is equal to 75% or more of the estimated economic life of the leased property. So they will give you what the estimated economic life is and what the fair market value of the life is. If it's 75% or more, then it meets this criteria. And you'll see, we'll get to a couple examples so you can see each one. And then finally, the present value of the minimum lease payments equals or exceeds 90% of the fair value of the lease property. So if the lease property is $100,000 today, the fair market value, you need to calculate what the present value is of the minimum lease payments. So you know what your minimum lease payments are. You calculate the present value. If it's 90% or more of the fair market value, then you've met this criteria. And you did present value back in intermediate accounting 2, I think, right? You did present value and future value. That's how you calculate this. So this is a good summary sheet that basically is how to determine whether you're doing a capital or operating lease. So you look at your lease agreement. So if you as an auditor goes into, or an accountant goes into a business, you ask them to see the lease agreement for a piece of their equipment, and you're going to go through these criteria, asking these questions, and you'll follow it, whether it's a yes or no. We'll tell you whether it leads to a capital lease or an operating lease, and it's the 4 criteria. First one being, is there a transfer of ownership? If the answer is yes, automatically becomes a capital lease. If the answer is no, move on to the next question. Is there a bargain purchase option? Again, same thing. Yes, becomes a capital lease. No, you keep moving on to the next question, and so on and so on. And if you go all the way across with no, you end up with an operating lease.
But if at least one,
If at
yes,
least one,
it's a
it's
capital.
capital lease. That's correct. And you'll see how fairly different the accounting for a capital lease versus an operating lease is. Capital lease is going to be more balance sheet items. Operating lease is just on your profit and loss statement. So it's basically rent expense and cash. And yeah, income statement is your profit and loss.
Operating is easy than capital.
It's the easiest one. If you have an operating lease, it's your easiest type of accounting. You're going to debit rent expense and you're going to credit cash. That's it. This one, the asset actually goes onto your balance sheet. Because think about it. You think of this one. Is there a transfer of ownership? It's like if you pretty much own the asset. Okay? So basically what I was explaining in 2 slides ago is just a little bit more information on what transfer of ownership means and what bargain purchase option means. Transfer of ownership, if the lease transfers ownership of the asset to the lessee, it's a capital lease, and bargain purchase option is at the inception of the lease, so at the beginning of the lease, the difference between the option price, which is the price for you to purchase it, and the expected market value must be large enough to make the exercise of the option reasonably assured. So what this means is they, on these type of leases, they'll make it like $1. Your option price is $1. So the lease will read, you have the option at the end of your lease to buy this for $1. It has to be large enough to make it sure that they're going to actually take the option to purchase it. Okay? Economic life test, as I mentioned, lease term is generally considered to be fixed, non-cancelable term of the lease. At the inception of the lease, the difference between the renewal rental and the expected fair rental must be greater enough to make exercise of the option to renew reasonably insured. Okay, and this was the last one, recovery of investment test, which was the 90%. The minimum lease payments are your minimum rental payment, guaranteed residual value, penalty for failure to renew, and bargain purchase option. So all of these are taken into consideration when you're calculating your minimum lease payment. That's why it lists these four. So if the problem gives you all this information, you need to include that when you're calculating what your minimum lease payment is. Executory costs are items such as insurance, maintenance, and taxes. This is excluded from your present value of minimum lease payment. So if the problem tells you that there's these type of costs associated in your minimum lease payment, you need to subtract it from that amount. You have to back it up. Okay? And you'll see that when we're going to do a problem and it's going to give you an example of this. Discount rate. So the lessee, when you're calculating the present value of your minimum lease, if you recall when you did this in Intermediate Accounting 2, you need an interest rate and a number of years to go to your table and find the present value calculation to use. What it's telling you is usually you're going to use your incremental borrowing rate. That's what they're going to refer to it. However, there is an exception, and this is an exception that's important to know. If the lessee knows the implicit rate computed by the lessor, and it is less than the incremental borrowing rate, then the lessee must use the lessor's rate. So if in my problem it tells me that my incremental borrowing rate is 10%, but then it says that the company, the lessee, knows that the implicit rate of the lessor is 8%, you have to use the 8% when you're calculating your net present value for your minimum lease. Okay? Always exceptions. You know that FASB wants to always make everything complicated, so there's always exceptions to the rules. Usually you use this incremental borrowing rate, but if the company knows that you're using an implicit interest rate lower than what your incremental borrowing rate is, you have to use this one. And I'll just give you an example. I am borrowing, I'm leasing from you a piece of equipment, and I'm assuming that my rate is incremental of 10. But you come and tell me I'm using an 8% rate for the calculation, I have to use the 8 because it's the lower of the two. Okay?
There is advantage for the lessee.
Yeah, I would see it as an advantage. What they just want to do is they want like the matching principle. You know how the basics of accounting is all about the matching principle. So whatever, FASB wants to make sure that whatever one company is doing on one side, the other one is matching the same thing. You don't want one company reporting more interest than the other. Okay. Assets and liabilities. So as we saw a couple slides ago, when the lessee first is reporting the lease agreement, you debit your asset and you credit your lease liability. That is reported at the lower of these two. So you're either going to take your present value of your minimum lease payment or the fair market value. So the first accounting entry that you would do when you make a lease is record the asset and the liability. How are you going to know what to record? You have to figure out both of these. Usually you'll know what the fair market value is because it's in the lease contract, but then you have to calculate with the present value of the minimum lease. Whichever of the two is lower, that's what you're going to record on your balance sheet. Depreciation. So in capital leases, since technically now the asset is on your balance sheet, you have the ability to depreciate that asset. And the way that you determine what life to use depends on if the lease transfers ownership or not. So remember, one of the criteria is, does the lease transfer the ownership? If the answer is yes, when you go to depreciate your asset, you're going to do it over the economic life of the asset. If The answer is no, they are depreciated over the term of the lease. So if you, let's just say furniture, right? Furniture usually for tax purposes is 7 years. This is the economic life of furniture. But let's say my lease term is a 5-year. If in my lease contract, the asset has transfer of ownership, then we're going to use the 7 years. But if it doesn't transfer, by the end of the lease, the furniture goes back to the owner, I'm going to use my lease term to depreciate the asset. Okay? All these are just all rules that you just have to memorize. Okay? Effective interest rate method is used to allocate each lease payment between principal and interest. We're going to look at this when we get to our problems. Basically, we're going to learn how to do lease amortization schedules, where you start off with the cost of your asset, and then for every, let's say it's 5 years, you're going to allocate a component to interest and a component to principal. And that's how you start reducing your liability. That's what the effective interest method is. And depreciation and the discharge of the obligation are independent accounting processes. So here we're going to start with our first problem. And for all the slides in today's lecture, it's going to always revert back to this same problem. So because of that, I'm going to write all the details here so that we can always look back to this. So it starts, Caterpillar Financial Services and Sturdy Construction Corp. Sign a lease agreement dated January 1st, 17. So our lease is January 1st, 2017. That calls for Caterpillar to lease a front-end loader to Sturdy. So Caterpillar is going to be our lessor. Sturdy is going to be our lessee. The terms and provision of the lease agreement and other pertinent data are as follows. So the term of the lease is 5 years. Lease term, 5 years. The lease agreement is non-cancelable, requiring equal rental payments of $25,981.62 at the beginning of each year. It's not important for you to know this right now because the problem is going to give you all the present value factors. But if you recall when you did present value and future value, you needed to know if it was at the beginning of the year, at the ending of the year, to know what table to pull your information from. So that's why it gives you that information that it's the beginning of the year. So the rental payments. $81.62, beginning of year. The loader has a fair value of $100,000, so the fair market value is $100,000. And the estimated economic life is 5 years. So notice that our economic life and our lease term are exactly the same in this case. So for depreciation purposes, it's not going to make a difference because it's the same number of years. And no residual value, that's important. Sturdy pays all the executory costs directed to third parties except for the property taxes of $2,000 per year. Executory costs. $2,000. Which is included as part of its annual payment. So we know that this $2,000 here is already included in here. So if you recall, we're going to have to back it out when we start doing our calculations. The lease contains no renewal options. So no renewal options. They give you all this information because of the 4 criteria. And the loaner reverts back to Caterpillar at the termination of the lease, so that means there's no transfer of ownership, so. Ownership reverts back. Reverts lessor. So at the end of the lease, the equipment goes back. Sterling's incremental borrowing rate is 11%. %. Sterling depreciates straight line basis, similar equipment that it owns. We don't need to write that because we know it's going to be 5 years straight line. And Caterpillar sets the annual rent. So here we go. We were talking about before. Caterpillar, who's the lessor, has his rate of return at 10%. And Sterling, the lessee, knows this. So why is that relevant? Because now we need to pick the lesser of the two when we're doing our present value calculation. So we know that the implicit rate, so lessors implicit rate is 10%. All relevant information. Okay, so now let's start with our accounting calculations. So, what type of lease is this? As I mentioned before, there is no transfer of ownership because the asset goes back to the lessor. So the answer is no. There was no bargain purchase option mentioned in our problem. So the answer is no here. The lease term and the economic life term are exactly the same. So here it's yes, because it's 75% of the economic life of lease property. And in this case, the present value of minimum lease payments is greater than 90% of the fair market value. It's 100%. It's capital. Yeah, because we met one. You only have to meet one. In this case, we met two. Correct. Just one. Once you meet one, automatically.
You don't have to meet the four, just one.
Just one.
Yeah.
One of the four. Okay. So now we all agree that it's capital lease. So the next thing we're going to do is compute the present value of the minimum lease payments. Why? Because remember, a couple slides before we said to record the asset and liability, you have to record the lesser of the two. So the next thing we're going to do is compute this present value of the minimum lease. Okay. Okay. So in order to compute the present value of minimum lease payments, if you recall, when you're going to calculate the present value of minimum lease payments, if we had a residual value, in this case we don't, but if we had a residual value, it would have to fall into this computation. I'm just making that note so you're aware. But in this case, they keep the problem very simple since we're just starting. We're going to take the regular payment, which is given to us in our problem, $25,981.62. As I mentioned before, we want to back out the executory cost because our problem stated that it was included in this number. We are now at $23,981. You're going to come up with your present value factor, which is this comes off the table. You have to go on pool. You're going to use the 10% interest rate because it's the lesser between the implicit and the incremental. So that's important that you use the correct interest rate because if not, this is not going to be correct. So the present value of your minimum lease payment is $100,000. So this is the amount we're going to record on our balance sheet.
You will have to use the 10%?
No, the lesser.
Less than 11%.
So you're going to look at
The lesser. The less.
where did
It's not 11%.
I not put the 10% one from the problem?
The
The increment, oh, here,
Yeah, the last
I'm sorry. So the incremental is 10, but the lessor's implicit rate is 10. It's the lesser of the two, whichever is less.
Yeah, whichever is less, you have to use
Correct.
always.
Correct. If they don't give you this, sometimes they may not give you this, then you automatically
You
use
have to
the
use the
incremental.
book.
Correct. But if they give you both, it says if the lessee knows what the lessor's implicit rate is, then you have to
And
use it.
if it was
Inverted,
Invert, yeah.
then always 10% too, even if
Yeah,
it's
it's
10%,
the less
it's the
one.
lesser of the two,
The
the lesser of the two. So we now know what our asset and liability that we are going to record on our balance sheet is. That is step one. You have to, you get a lease, you have to record the asset and the liability on your books. So, you're gonna debit your leased equipment, $100,000, and you're gonna credit your lease liability, $100,000. You now technically own this asset while it's under a lease because it's capital, and you owe $100,000 to your lessor. Okay? Your first lease payment that's made, remember, we know that the payments are $25,981. So you're gonna give cash of $25,000 to the lessor, and this is how you're gonna break up your payments. You're gonna put $2,000 to your property tax expense, and you're gonna put the remaining amount to start reducing the lease liability. So this is what your lease amortization schedule looks like. And when you are preparing financial statements for companies, this is required as a disclosure note in your financial statements. So if the company has a lease, this has to be included as part of the notes. You have to do your whole amortization schedule and attach it to your notes. So all it's basically telling the end user is there's a lease on the books, this is the beginning of the lease, and this is the allocation of payments, liability versus principal versus interest, and any cost associated with it. So your first payment of $25,981. Since the payment takes place at the beginning, which is right when the lease started, there's obviously no interest accrued because there's been no time passed. So the first payment has no interest. The entire payment goes to your lease liability. So your 100 minus this 23,981 equals your 76,018. You're then going to go and calculate the interest at 10%. 10% of this is 7,601.84. You see, you follow? So your next payment 25 minus the 2,000. We know what the interest is. The remaining amount goes to principal, and so on. Keep reducing it all the way till you get to zero. So when your lease liability at end of the 5th year is going to get to 0.
But those 25, you're going to split during the year, no? And then give you the end of the year balance.
What do you mean split at the end of the year? The payments are made at the beginning of the year. Remember our problem said that? So that's why all the payments are at the beginning of the year. So every beginning of the year, I have to take $25,000 and give it to the person that leased the equipment to me. From that 25, what you're doing on your books is breaking out how that 25 should be allocated. We know 2,000 of that
What's the trend line amortization?
we know that that
No.
2,000, say again?
The trend line?
What do you mean straight line? Not straight line, it's based off of your interest. So you take your 25, we know 2,000 automatically gets allocated to the executory costs, because our problem told us that. So now we're left with 23,981. You have to break apart what's interest and what's principal. You know what interest is because you're calculating 10% on an annual basis, 10% of your principal balance, your outstanding principal balance. 10%.
Your remaining balance, and then you pay.
Correct.
And then
So you know from that 23 that's left, after your 2,000 gets allocated here, 7,601 goes to interest, the remaining amount goes to your principal. And so on and so on. So now you're gonna reduce this 76 by your principal reduction. You're gonna be left with this amount. You're gonna take 10% of that as interest. And you keep going. So your total interest on the entire lease is $19,908, allocated over 5 years. This was all your principal payments over the 5 years, totaling $100,000. My 100, plus my 19, plus my 10 equals my total payments that I paid the lessor.
No, because what I was thinking is like that, those 25, like at the beginning of the year, but not like, but you distribute it during the year. It's not like one payment.
No, it is one payment. In this case, it is one payment. Yep, that's the problem, told you it's one payment. It's unusual, in real life terms, you're paying monthly basis, you're not paying annually. But yes, this is on an annual basis. They're trying to simplify it, to start teaching you on a simplified basis. And it can get very complicated. This is interest, but simple interest. There could be compounding interest, and then it gets very complicated when you're compounding on interest. So, prepare the entry to record the accrued interest at the end of the year. So, it's just asking you at the end of 2017, you know that you're going to end up paying interest at the beginning of 18, so you have to record your interest. So this interest that you paid in 18 is associated to 2017, so you have to actually accrue for it. So you're going to debit your interest expense for $7,601, and you're going to credit interest payable. So when this payment is made on 1/1/18, this 7,601 is just going to reduce your interest payable down to zero. Follow up?
Because it's at the beginning of the year, you have to calculate the year prior, no?
So it says prepare the required on December 31st, 2017 to record depreciation. So in this case, our problem stated that it was straight line. 100,000 divided by 5 years, which was our economic life, gives you $20,000 of depreciation expense every year. So you're going to debit your depreciation expense, and you're going to credit accumulated depreciation. So at the same time that you're paying the lease, you're also depreciating the asset. Okay? And this is just giving you presentation of what your balance sheet's going to look like. You're going to have your current liabilities, your interest payable that we recorded, your lease liability of $16,000, and your remaining lease liability of $59,000. And all this is doing here is just breaking out current versus non-current. So if we continue on, it says Sterling records the lease payment on January 1st as follows. So this is what I was explaining to you. So now comes the time to make that payment on 1/1/18, right? So we know we paid $25,981, and it's allocated by $2,000 to property tax expense. $7601 goes to our interest payable that we had accrued for the month before, or the year before, I'm sorry, and your lease liability because it's principal, reducing your liability of $100,000. Good. Okay, so now that was capital method. Now we're jumping into operating method, which, as I explained to you, is very simple. You're going to debit your rent expense, you're going to credit cash. So the lessee assigns rent to the period benefiting from the use of the asset and ignores in accounting any commitments to make future payments. So it doesn't take into account any future payments. In this case, assume Sterling accounts for the lease as an operating lease. Sterling records the payment on January 1st as follows. Look how simple this is. That's it. Rent expense and cash. So what happens? Businesses usually, when they're negotiating these contracts, the lessee tries for the most part to try to simplify the agreement so that they don't have to get into this complex accounting. And they try to make it operating leases. And you as accountants or auditors, when you go into these businesses to audit their company, you need to read these lease agreements to make sure that they're recording it correctly and not doing it as an operating lease when it should be capital. Because that was one of the most common mistakes I would find, even when I was just doing taxes for clients. I would find that they would be recording their leases incorrectly. They should have been capital leases, but it's operating leases.
And what about if for example, I don't know anything about accountability, and I go to make a lease, I have to sign they give me to sign the lease, and I don't know nothing about it.
Well, usually they will have attorneys get involved in these large contracts. These are usually very large lease agreements. You're talking about hundreds and hundreds of thousands of dollars. Companies will usually have an attorney involved or a CPA involved in putting all this together. And it's not only for these type of leases. I do the same thing in my job for leases for rent. So when we're negotiating leases for our properties, I have to get involved because as a CPA, I know certain tax laws that there are that they have to word it a certain way so that we get benefit in taxes. So I'll work with the attorney to make sure that they're wording it correctly. And then you'll have the landlord and the tenant fighting how they want to word it so that each person gets the best tax benefit. And it's the same thing here. So, and again, if you may just be a new accountant that started a company, you may not be aware of all these rules. So you may just sign a lease agreement and have no idea, or record it just like this. That's the job of an accountant, a CPA, or an auditor to come in and tell you you're doing this incorrectly, you need to fix it. Okay? Because they cannot sign off on those financial statements as them being correct without making these changes. So this slide, all it's basically showing you is that a capital lease versus an operating lease ends up the same. At the end, it's always the same. There's no difference in zero. It's just the timing of when you're recording the expense. So you see, in this case, the payments, the expense is accelerated earlier in the life of the lease. Here it's just spread evenly across. Here you're accelerating it earlier. But at the end of the day, it nets to zero. There is no difference, whether one or the other. It's just the timing.
Capital lease depends on the interest.
Sorry?
In capital lease,
What about?
what is the difference in capital lease to operating lease? Is the difference the interest or?
Correct. So yes, you're correct. You have interest expense versus rent expense. That's correct. But actually, remember, when you do a capital lease, you get depreciation that you don't get here. So at the end of the day, it's nets to zero. Because even though you're getting this interest on your profit and loss, you're going to end up depreciating $100,000 of this asset to your income statement. So you're going to end up taking $100,000 in depreciation and $19,000 in interest. Versus here, you're just taking $129 in rent expense. It's just timing. It's timing. Is all it is.
The interest and the depreciation is variable, or the interest is variable. The depreciation should be the same.
I don't understand your question.
The interest is variable, it's different.
Oh, variable.
It's variable.
No, but it's still going to be the same.
It's
Because
the same
your
amount.
payments are the same.
The interest is the same, the amount that is variable.
Correct.
It makes a different amount.
Timing, but timing-wise.
But
Only,
in the other place, it's the same amount all the time.
yes.
Every-
Right. Because in this case, it's not called interest. This is just rent
Yeah.
expense, rent expense, rent expense. I mean,
It's the same every year.
okay.
No, complicado.
Now,
No, tienes un libro ahí delante de ti.
let's take a 2-minute break so I can pause this. And then we'll jump into lessors.